What is an employee stock option plan and how does it work? Generally, companies seek to compensate their employees with a combination of cash and equity. Equity is an ownership interest in the company. Oftentimes that is shares of stock in the company. But instead of actually granting the shares to the employee outright, companies oftentimes construct a plan known as a employee stock option plan. And pursuant to this plan, the company grants an option to the employee to purchase an ownership interest in the company. More specifically, stock option plans authorize what are called call options, which means you're granting to someone the right to purchase an ownership interest in the company at a set price. That set price is known as the strike price, and that price is always the current value of the stock. And that right will last for a certain period of time. Now you may be asking, why would I want a right to purchase an ownership interest in the company at the current price? Well, the reason is this. If you cannot openly purchase an ownership interest in the company out on the open market, the right to purchase an ownership interest is a privilege. But the right to purchase an ownership interest at the current value, and that right continues on into the future, even if the value of the stock increases, that's a very valuable thing. Because I'm giving you something, a contract right, that will likely go up in value in the future, and you will not be taxed on that until you exercise that right. So if I grant you a stock option today to purchase stock at $1, and 10 years from now the stock is worth $10 a piece, well, you still own that interest to purchase stock at $1. Well, the right to purchase the stock at $1 is now worth $9 because the value of the company has gone up $9 to $10. So that's why it's valuable to employees. It avoids the employee being taxed on something immediately until the future, and it allows them to take advantage of any growth in value of the company. So that's how stock option plans work and are structured. Now, generally, employees just don't receive a bundle of stock options at one time. They are granted the stock options, and their ownership of that stock option vests or becomes real over a period of time. This is called a vesting period. So I may grant you stock options, option to purchase an ownership interest in my company, and it vests over a 12-month period. So either every month or at the end of the 12-month period, however we structure it, you will receive the ownership right at that time. You don't have to exercise the option at that time, but the option becomes yours. You are now the owner of it. If something happened before the vesting period has ended, then the option goes away. You don't become owner of it. So that's what a vesting period is. Now, during that period of time, say the vesting period is 3 years, and during that 3-year period, the value of the company has gone up 100 times. Well, you don't want to have to pay taxes on receiving a stock option at that future date at 300 times the current value. You wanted to receive it at when it had zero value very early on. So when you have a vesting schedule, you can make an 83B election, as they call it. That is an election to recognize the stock as your own for tax purposes at that time. So that's an important thing, and that's oftentimes covered in the stock option plan. Now, the general rule about the stock options is you do not pay taxes on that stock option because you haven't gained or realized any value at that point in time. You only pay taxes on the stock option when you exercise that stock option, meaning that you purchase the stock pursuant to your right at some point in the future. And if the value of the stock has gone up, say from $1 to $10, and you buy 10 stock for $1 each at $10, but you receive $100 worth of stock, at that point in time, you'll be taxed on the $90. Now, there are two types of stock options, one called incentive stock options, which are available for key employees and management of the company. And then there's non-qualified or non-statutory stock options, which are just for third-party contractors or anyone who is not a key employee or management of the company. And the difference between the two is they're generally structured very similarly. It's just they are treated differently for tax purposes. When you ultimately exercise your stock option and you buy shares that are way more valuable than what you pay for them, incentive stock options are taxed as capital gains, which is a much lower tax rate than for non-statutory or non-qualified stock options, which any amount that the stock has gone up in value is taxed at normal income rates, which is generally much higher. So depending on the type of stock option that you have, the real value there is to save when it comes time to exercise the option so that you don't pay as much in taxes. All right. Now, an employee stock option plan will have numerous smaller micro provisions, but these are the primary provisions. So some of the things that will be addressed in the plan are exercise rights. What do you actually have to do to exercise your rights? What is the time period? That type of thing. It will state whether you can actually purchase an ownership interest in the company, or you also have the right to force the company simply to purchase back your options rather than you actually exercising the options and purchase them. So repurchase right. And sometimes the company will even say at the period of time that you can exercise the stock option, you can reload them or trade them out for additional stock options going into the future. So there are many, many different provisions and scenarios that are oftentimes included in employee stock option plans, many of them related to what happens during the vesting period and what happens during the period of exercise and the means or method of exercise and that type of thing. But as long as you understand that this is how employee stock option plans function, these are the key provisions, and everything else is just a minor variation in how they function. So these are the key provisions for you to understand.